You just got your paycheck. You transfer $500 to savings like you're supposed to. You check your savings account balance, $12,847. You feel responsible. You're doing the right thing. Then you look at rent prices in your area, up another 3% this year. You look at your grocery bill, coffee and tea alone are up 11.8% from last year. You look at that car you've been saving for. It costs $3,200 more than it did 18 months ago. And you realize something that makes your stomach drop. Your savings account is paying you 0.39% interest, while everything you actually need to buy is getting 3 to 5% more expensive every single year. You're not building wealth, you're just losing slower. If that realization hit you like a freight train, you're not wrong. And what I'm about to show you is going to completely change how you think about saving money in 2026. Let's start with the raw numbers because the numbers are brutal. According to FDIC data from February 2026, the national average savings account interest rate is 0.39% APY, not 3.9%, not even 0.9%, 0.39%. Meanwhile, the annual inflation rate for the 12 months ending February 2026 is 2.4%, according to the U.S. Bureau of Labor Statistics. Let me show you what that means in practice. You put $10,000 in a savings account earning 0.39% APY. After 1 year, you have $10,039. But because of inflation at 2.4%, you need $10,240 just to maintain the same purchasing power you had at the start of the year. You earned $39 in interest, but you lost $201 in purchasing power. Your net loss? $162, or 1.62% of your savings. You literally got poorer by saving money. And this isn't some edge case. Bankrate's survey of institutions as of March 28th, 2026 shows the national average savings yield is 0.6% APY. Even at 0.6%, you're still losing 1.8% of purchasing power every single year. Now you might be thinking, Dave, you're cherry-picking the worst rates. What about high-yield savings accounts? Good question. Top high-yield savings accounts are offering up to 5.00% APY as of March 2026. That's way better, right? Here's the problem. Those 5% rates are rare, usually require you to jump through hoops, and more importantly, they're not keeping up with the real cost increases in things you actually need. Food prices increased 3.1% from December 2024 to December 2025, with food at home rising 2.4% and food away from home jumping 4.1%. More specifically, beverage materials including coffee and tea rose 11.8% in 2025. Medical care prices rose 3.2% in 2025, with hospital and related services surging 6.7%, their largest December-to-December increase since 2010, and housing? Rents may rise by about 2% to 3% year over year by the end of 2026, according to Redfin. In some markets, it's way worse. San Francisco saw a typical rent jump from $3,362 in 2025 to $3,830 in 2026, a 13.9% increase in 1 year. Reno, Nevada, and Chicago, Illinois each saw 6.5% rent increases. So even if you're earning 5% in a high-yield savings account, you're barely breaking even when you factor in the real inflation rate on things like healthcare, housing, and food. Let's talk about the elephant in the room. Housing costs, because this is where traditional saving advice completely falls apart. As of mid-2025, the Atlanta Fed's Housing Ownership Affordability Monitor shows that owning a median-priced home consumes a staggering 47.7% of the median household's income. That's almost half of what you make going to housing alone. This is dramatically above the 30% threshold traditionally considered affordable. But between the start of 2020 and the third quarter of 2025, home prices climbed nearly 55% nationwide, according to the National Association of Home Builders. So you're saving at 5% per year, while home prices are appreciating at 10 to 15% per year in many markets. You're literally never going to catch up. The goal is moving away from you faster than you can run toward it. And for renters trying to save while paying rent, The number of cost-burdened renter households hit a record high of 22.7 million in 2024. That's 49% of all renters spending more than 30% of their income on housing. If you're spending half your income on rent and prices are going up 3 to 6% a year, you're not saving your way out of this. The math doesn't work. All right, so if traditional savings accounts are a slow-motion wealth destroyer, what actually works? Let me give you the real alternatives with actual 2026 numbers. Treasury I-bonds. The composite rate for I-bonds issued from November 2025 through April 2026 is 4.03%. This includes a variable portion of 3.12% based on inflation data and a fixed portion of 0.90%. Here's why I-bonds are interesting. That variable rate adjusts with inflation every 6 months. So if inflation spikes to 4%, your I-bond rate goes up. Your savings account? Still stuck at 0.39%. The catch? Maximum purchase each calendar year is $10,000, and you can't cash them in for at least 1 year. If you cash before 5 years, you lose 3 months of interest. So I-bonds are great for money you won't need for at least a year, but you can only put $10,000 per year into them. If you have $50,000 to deploy, I-bonds only solve part of your problem. Look, high-yield savings accounts aren't completely useless. The best high-yield savings accounts are paying around 4 to 5% APY as of March 2026. That's 10 times better than the 0.39% national average. And for an emergency fund or money you need to access quickly, it's your best option. But you need to understand what you're using it for. It's not wealth building, it's wealth preservation at best. And even then, you're barely keeping pace with real inflation. The strategy here is keep 3 to 6 months of expenses in a high-yield savings account for emergencies, except that this money is losing 0 to 2% purchasing power per year. Understand that this is the cost of insurance for having liquid cash available. Now you might be thinking, what about just investing in the stock market? Here's the reality. The S&P 500 rose 17.9% in 2025, including dividends. That absolutely crushes any savings account. Over the long term, the stock market has historically averaged around 10% annual returns. Even in 2026, analysts are forecasting an average return of 12% for the S&P 500, citing continued earnings growth and resilient consumer demand. But here's the problem: volatility. The S&P 500 experienced significant volatility in 2025, including an almost 19% decline during the first half of the year before rebounding to finish well in the green. So yes, stocks beat savings accounts over time. But if you're saving for a down payment and you need that money in 18 months, you cannot put it in the stock market. You could be down 15% the exact month you need to buy. Stocks work for money you won't touch for 5 to 10 plus years. They don't work for short-term savings goals. Here's what actually makes sense in 2026. Tier 1, immediate access, 1 to 2 months expenses in checking account. Yes, earning nothing. This is for day-to-day life. Tier 2, emergency fund, 4 to 6 months expenses in high-yield savings earning 4 to 5%. This is your oh crap money, not for wealth building, for emergencies. Tier 3, 1 to 3 year goals, money for goals. 1 to 3 years out goes into a mix of I-bonds, up to $10,000 per year, and short-term treasury bonds or CDs. You're trying to beat inflation by 1 to 2%, not trying to get rich. Tier 4, 5+ year goals. Everything else goes into low-cost index funds. Yes, there's volatility. But over 5+ years, you need growth to outpace inflation, and historically, stocks are your only real option. The entire just save money advice assumes that inflation is low and stable, and that savings accounts pay reasonable interest rates. Neither of those things is true in 2026. We just came through a period where median rents for 2025 were 4.8% higher nationally than in 2024, according to HUD estimates. In some states, it was way worse. Montana saw rents projected to be 20.7% higher than 2024, while Idaho saw a 20.3% increase, both more than 4 times the national average. The old rule was save 20% of your income. But if your rent goes up 6% this year, your grocery bill goes up 3%, your health insurance goes up 5%, and your car insurance goes up 10%, you're not saving 20% anymore. You're scrambling to save 5%. And that 5% you managed to save, it's sitting in an account earning 0.39% while real costs are rising at 3 to 6%. This is why saving money feels pointless, because under these conditions, it kind of is. Here's the uncomfortable truth that personal finance gurus don't want to tell you. In a high inflation, low interest rate environment, holding cash is a losing strategy. You need to shift your mindset from saving money to deploying capital into inflation-resistant assets. That sounds fancy, but here's what it means in practice. If you're saving for a car and car prices are inflating at 5 to 7% per year, you're better off buying the car now if you need it than saving for 2 years and watching the price go up $4,000. The traditional advice was save up and pay cash. But if the asset you're saving for is appreciating faster than your savings account interest rate, you're actively losing money by waiting. This is why institutional investors made up a record high 30% of single-family home purchases in the first half of 2025. They understand that real estate is an inflation hedge. Your dollars in a savings account are not. The wealthy don't have $100,000 sitting in savings accounts earning 0.39%. They have money in index funds that historically return 10% annually, real estate that appreciates with inflation, bonds that adjust with inflation, short-term treasuries yielding 4 to 5%. The difference between 0.39% and even 5% over 30 years is the difference between wealth and poverty. $50,000 at 0.39% for 30 years becomes $56,217. $50,000 at 5% for 30 years becomes $216,097. $50,000 at 10% for 30 years becomes $872,470. Same starting amount, same time horizon. The only difference is where you put the money. Look, here's the bottom line. Traditional saving is dead in 2026. Not because saving is bad, not because you shouldn't have an emergency fund, but because the math of putting money in a savings account and expecting it to build wealth doesn't work anymore. When the national average savings rate is 0.39% and inflation is 2.4%, you lose 2% of your purchasing power every year. Over 30 years, your $50,000 turns into the equivalent of $27,427 in today's dollars. You literally cut your wealth in half by doing what you were told was the safe, responsible thing. So what replaces traditional saving strategies? Speed. If you're saving for something, save faster and buy sooner. Don't let 2 years of 5% annual price increases eat your savings. Tiering. Emergency funds get high-yield savings. Everything else gets invested in assets that outpace inflation. Asset allocation. Stop thinking in terms of cash and savings. Start thinking in terms of 30% in liquid assets earning 4 to 5%, 60% in index funds, 10% in bonds. Inflation hedging. Understand that inflation is not your friend. Every dollar sitting in a low-interest account is a dollar losing value. Act accordingly. All right, here's what you need to do right now. Check your current savings account interest rate. If it's under 4%, you're leaving massive money on the table. Move to a high-yield savings account immediately. This is a 10-minute task that can earn you an extra $400 to $500 per year on a $10,000 balance. Calculate your real return. Take your savings account interest rate and subtract the inflation rate. If that number's negative, you're losing money. Plan accordingly. Set up the tiered system. Move money you need in the next 6 months to high-yield savings. Money you need in 1 to 3 years to bonds or treasury bills. Money you won't need for 5+ years to index funds. Stop saving for things that are appreciating faster than your savings rate. If you need a car and car prices are going up 7% per year, buy now or figure out how to not need a car. Saving for 18 months while the price goes up $5,000 is not smart math, except that the old rules don't apply anymore. Save 20% of your income in a savings account made sense when savings accounts paid 5% interest and inflation was 2%. That world doesn't exist anymore. The math is not ambiguous. It's not pessimistic. It's just arithmetic. $10,000 in a savings account at 0.39% loses $162 in purchasing power per year. Over 10 years, that's $1,620 in real wealth destroyed. Over 30 years, you've cut your purchasing power in half. This is why young people are frustrated. This is why just save money feels like a joke, because the system is literally designed to punish savers and reward people who deploy capital into inflation-resistant assets. The good news, you can fix this today. Move your emergency fund to a high-yield account. Buy bonds if you can. Invest money you won't need for 5+ years. Stop letting inflation silently rob you while you do the responsible thing. The rules changed. Your strategy needs to change too. If this video changed how you think about saving money, hit that subscribe button and drop a comment telling me what percentage your savings account is currently earning. I'm genuinely curious how many people are stuck at 0.39%. Now go move that money.